Thank you. All right, well, in the spirit of shocking predictions and having a bit of fun, I expect that Donald Trump won't make it past the next set of elections. But China's, I hear a few claps there, but China's rise in the global economy will remain an uncomfortable threat for the US. And absent of a military war, Americans will continue down the path of trade wars to the point where they'll stop trading with China completely. So as much as I love hearing Hamish and Andrew, I completely disagree with what they said. It's a dangerous thing to do. So the world will break into two economic trading blocks, those that trade with China and those that trade with the US alliance. Australia will be confronted with one of the hardest decisions of all over the past century, whether to follow China to economic prosperity or to follow the US alliance over security and democracy. It'll end up forcefully choosing the latter. Now, this will have significant consequences for the Australian economy in a number of areas. But one aspect that I just want to touch on is inflation. Now, the chart here on the left-hand side shows what the market is predicting and thinking would be the average inflation rate in Australia over the next decade. It's about 1.1%. Of course, you know that the RBA targets inflation over the medium term between 2 and 3%. The chart on the right-hand side shows the actual rolling 10-year inflation rate in Australia over the last 70 years. It's rarely been below about 2%. So under this prediction, I think Australians are in for a rude shock. So my simple message, buy inflation protection today. It's ultra cheap. Thank you. Cheers.
Thanks, Jay. Our next speaker is Charlie Jamison from Jamison Coop Bonds with prediction number 2. Hand it over to you, Charlie. Just bring it forward one when you're ready to give a...
I actually argued the wrong way around from the way that I really believe the markets are constructed this morning. I'm not sure if any of you picked up on that. But I'm sorry to tell you that I do believe that negative interest rate policy is going to be with us for some time, certainly 2020 and then beyond. And there's good reason to believe that. Certainly we're very much stuck in that framework in Japan, and we're about to go deeper into that in Europe this week. But we have had some changes. There's a very good reason why people don't want to sit next to me at dinner parties, because when I start talking about things like the zero lower bound being changed to effective lower bound from the US Federal Reserve communication policy, they tend to try and move seats and sit next to their real estate agents who are very popular again. But that is something that is tremendously important. It is recalibrating markets' expectations for where this can go. The Fed themselves have written a number of papers about potentially using negative interest rate policy. Greenspan only 5 days ago said in the next downturn we will absolutely have negative interest rates in the United States. I actually don't think we'll get there very easily in Australia, thank heavens, but it is something that is going to be tremendously challenging for the industry. Clearly there is a secular re-rating through riskier assets which do enjoy this in the first iterations of this recalibration. But the problem is we're using these policies because we are really pushing on a string in many respects. And it is likely that we are going to, once we get into these kind of black hole moments, it can be very, very difficult to extract yourselves. If you do try and extract yourselves by having the political will and strength to go the long term on it, it's going to make Hong Kong look like a picnic. There will be just vast social uprising, given the distortions that it will have through the entire risk complex to back out from this. So it's not a pretty picture, and unfortunately it's a tremendous challenge for the industry. Certainly any of us that work in providing defensive solutions need to get much more creative about the way that we're going to do that for you, because unfortunately I would much prefer to be the bond manager with 5% yielding bonds, but that's just not the world we're going to find ourselves in. And it's very likely that everybody will get drawn into this, certainly the longer that we stay in it, in both those bedrock nations of Europe and Japan, which provide that anchor for much of this and are drawing us that way. So I'm sorry to tell you, but I think it's here to stay for a little while longer yet. Thank you.
Thanks, Charlie. Our next speaker is Dr. Philip Hoffman from Lazard Asset Management. Phil, come to the stage. just press it forward once when you're ready.
Thank you very much. Look, I have to admit, what I have is not so much a prediction as a warning, and it's actually a very old topic, but one I think that we've become complacent about. China's a great consumer story, but we're mostly linked to the capex cycle over there. And it's fair to say that in Australia, everybody's given up worrying about the Chinese capex cycle, because rather like in the story of the boy that cried wolf, there have been far too many false alarms. What I want to argue today is the risk is still there, and it's actually much higher now than it has been in the past. The narrative today about China is that nothing can possibly go wrong because they have a very strong economy and they have an omnipotent government that will stop anything ever going awry. Interestingly enough, when they had the last recession, just after the Soviet Union fell, the narrative was the exact reverse. Back then, it was received wisdom that a centrally run economy can never prosper. We've come 180 degrees. I think both are wrong. Let me give you a statistic. We've looked at tiger economies, Japan, Korea, Taiwan, Hong Kong, Singapore, during their most tigerish decades when they were industrializing and urbanizing very rapidly and had strong central governments. And during that period, they had significant capex downturns, well in the double digits, once every 7 to 8 years. In other words, this is the norm. China's the exception, because whenever there's a downturn threatened, they kick the can down the road by cranking up debt even more. But China actually has a limit in this, and the limit is the external account. They used to have an enormous surplus, but they cashed in most of it in the GFC through that huge stimulus package, and what remained was further diminished in 15-16 when they again bailed out the economy. And it's building up imbalances in China. If they were faced with another deep downturn, they could really not do what they did in 2008-9 without going into significant deficit. And I think that's unlikely, given that would put them in a very vulnerable position in this trade war. So what I want to say to you, in that story of the boy that cried wolf, the wolf eventually came and ate the boy. It's worth keeping that in mind. So I think the risks are today actually higher than they were in the past. Keep your eyes on China, because even the Chinese Communist Party cannot amend the laws of economics. Thank you.
Thanks, Philip. I'd like to welcome Anthony Abboud to the stage for prediction number 4. That's your clicker, just moving forward. Thanks.
Just a bit of background. Over the last 6 months, we've seen in the UK specifically both H2O and Woodford, a couple of funds which have offered daily liquidity. Woodford specifically had to sort of shut up, or put the gates up. And my prediction is that I think this is the tip of the iceberg, and it was a bit of a liquidity crisis. I think this is the tip of the iceberg, and I feel that managed funds and ETFs offering daily liquidity, which are liquefying the illiquid, I reckon there's going to be a lot more problems over the next, really big problems over the next 12 to 18 months. To demonstrate my problem, I thought I would use an ETF, the latest thematic high. It's the cannabis ETF. Now look, it's $1 billion fund. It's got it looks very liquid. It trades about 20 million Aussie dollars a day. It's sort of, some days it's done $200 million. By the look of this ETF, you can get in and out as much as you want on a daily basis. But let's look under the hood. Now, it's got its typical names like Canopy and Kronos, etc., but just under 15% of the fund are made up of these 4 companies. Now, this ETF is the largest shareholder in CanTrust, all these different names, at 13% of the fund. These are 200 to 300 million market cap companies. I'd argue that's not terribly liquid. I'll give you an example of CanTrust. It's had a pretty tough couple of months. In the last couple of months, it's had an investigation by OSC, which is the Canadian equivalent of ASIC. It's had Health Canada shut down one of its greenhouses due to non-compliance. KPMG's withdrawn its audit for 2018. Its CEO got fired with cause. Its founder got forced to resign. As you can see, the share price has sort of come under a little bit of pressure. But the good news is it's a bit of a cost out story. They've just fired 180 people. You might say that there's some potholes in the road. Sorry. You can see the share price has fallen, but you can see CanTrust. it's actually gone. So the ETF has gone from 6% to 13% of the outstanding shares. I would argue owning 13% of a company with 250 million market cap with all those issues is not a liquid position. Now, I look at that ETF. Now, the share price of the ETF's come under a bit of pressure, but what I'd note is that the fund inflow has still been in fund inflow. If that were to turn to fund outflow of 20, 30, 50 million dollars, I can tell you the ETF manager will try and liquidate the positions the same, but it won't be able to sell any of this 13%. So the illiquid positions will become a bigger proportion of the funds under management. And so it will become a bit of a downward spiral. But I want to leave you with two things. I think you've got to be careful of funds and ETFs which liquefy illiquid assets. And the second thing I would make is liquidity dries up in a bear market. Thank you.
Can I grab that clicker? Oh, yeah, cheers. Ladies and gentlemen, prediction number 5 comes from Ben Griffiths, who's portfolio manager at Ely Griffiths Group. Ben, please come to the stage. Give us your prediction. Here's your clicker.
Forward that one. Good afternoon, ladies and gentlemen. When I last addressed Livewire Live in 2016, I conveyed my great concerns for the health of the listed aged care sector, a sector at the time that was popular, I guess because the share prices were seemingly going upwards and upwards, almost unstoppable. My concerns for the sector centred around the risk that government funding would be pulled or heavily modified, that the balance sheets of the individual operating companies were heavily extended, and just as importantly, the median house price in Australia would come under some sell-off. That was back in 2016. I guess all of those elements came to pass in the ensuing period. The result is there to be seen. The red line is the hybrid of the 3 listed aged care operators, and the blue line is the performance of the Small Ordinaries Accumulation Index. You can see from a common base back in December 14 that the aged care operators, in fact, are down about 30%. Meanwhile, the Small Ordinaries Accumulation Index is up about 40%. So it's been painful. Essentially, the sector has lurched into crisis. Share prices have been abysmal. This chart highlights the extent of the sector's dilemma. It's under extraordinary financial distress. You can see the number of providers in the heavy black chart, the black line, has reduced from just over 1,000 to just over 850 providers. You can see the grey line, which has gone into essentially a nosedive, is the profit before tax margins that the operators enjoy. Essentially what we're seeing is revenues per place are up $15 a day, but costs per place are going up $30 a day. And the red line is the most important of all. That's the return on assets, and that's slumping. Operators, basically in response to poor profitability, have stopped investing. So this trend is completely and utterly unsustainable. Enter the Morrison government last October. They've launched a Royal Commission, essentially investigating aged care quality, the operators, and bad practice. We should hear an update from the government on how the Royal Commission is going in October of this year, ahead of its final report in 2020. But these trends here are completely unsustainable. So, the path forward. We think the Royal Commission will set the scene for structural reforms, regulation change, and more than likely the Morrison government will be forced into revisiting the funding packages. Private sector operatorship in this part of the market, in this particular discipline, is critical to the sector's success and ultimate survival. We think, as an outworking of the Royal Commission and its findings, you'll see sector consolidation and merger and acquisition activity happen. That also is inevitable. And I have a hunch right now that private equity is busy looking at the space in terms of how it should be positioned. The listed companies are generally the better operators in the sector, so we think that any changes the government enforces will actually benefit the listed sector at the expense of the less able and less resourced private sector and not-for-profit sector. And by the way, each of the 3 listed vehicles are trading at below replacement cost. So these vehicles are absolutely trading at scorched earth valuations. Now this chart here very quickly reinforces the importance of the proposition. Essentially, 85 years and above population growth is the key demographic in an aged care facility. You can see that rising. The grey line, the light grey line, is the number of beds. As you can see, they're adding a very mild addition to the stock. And the red line is the uptick in utilisation. So you can see roughly FY20, calendar 20 perhaps, we will see the coalescing of a bottom in both population growth for the over 85s and utilisation, whilst bed growth remains subdued. I'm reminded of an old market maxim that says when the time comes to buy, you won't want to. You can't find a single person today that speaks favourably about these stocks. These are fallen angels. We believe the Royal Commission will provide the perfect point where you'll start to see a line of sight to recovery in this sector. And we believe there are dollars to be made for patient investors who are happy to ride through the repair process. Thank you.
Thanks, Jamie.
Thanks, Jimmy.
Well done, mate. Thank you.
Thank you.
Thank you, Ben. Prediction number 6 comes from Ben McGarry from Totus Capital. Please welcome to the stage. Put your hands together.
Thanks, James. Just over a year ago, in August 2018, I wrote a piece for Livewire called Peak Ironman, in which I said it was finally time to short Tesla. It was a day after the now famous funding secured tweet from Elon Musk, which he announced via Twitter an offer for the company to take it private at $420 a share. The stock is now down 38% since then, and is down 30% so far this year. It's our largest short and already our most profitable short ever, and we think it has further to fall, a lot further. In fact, we think that the company is probably worth less than its debt, which means that our price target for the equity is 0. We see a good chance of this happening by the end of 2020, just 15 months from now. Tesla exhibits many of the hallmarks of our best shorts in the fads, frauds and failure space. In fact, it has so many hallmarks that it was hard to whittle them down for this pitch, but we've given it a go. Pressure to maintain numbers, end-of-quarter price cuts, production and delivery pushes, cash balance window dressing, and payment deferrals are a staple for this company. Fear and silence. Tesla is a highly litigious organisation. If you're interested, you should pick up a copy of the new Tesla book by auto journalist Ed Niedermeyer called Ludicrous. The introduction is worth a read. Young'uns and a larger-than-life CEO. They don't come any larger than Elon. His CFO, Zach Kirkhorn, is 34 years old. A weak board. Tesla's board of directors is the second highest paid board in the USA. Elon's brother, Kimball, a chef, was paid $6.8 million to sit on the board last year. Conflicts of interest. Tesla's bailout of Solar City, by a company run by Musk's cousins, with Elon as the largest shareholder, is currently the subject of a class action by Tesla shareholders. Innovation like no other. Solar roof tiles, autopilot, robo-taxis. Tesla is a world leader in products that are not quite ready yet. Goodness in some areas atoning for evil in others, saving the planet as cover for misleading and deceptive conduct. Looking at the numbers, in a nutshell, Tesla can't make cars cheaply enough to be profitable, so they keep running out of money and needing to raise cash. Debt and equity issuance have skyrocketed in recent years, which has resulted in their access to capital becoming smaller and more expensive. Tesla is the world's most expensive auto company because of the perception of growth. But how do you grow when your spend on growth and maintenance capex is collapsing and now sits below depreciation? Now that competition has arrived in the EV space, Tesla has a demand problem and so needs to keep cutting prices. Tesla is facing problems on almost every front. Customer and investor trust, scrutiny from regulators, intensifying competition, mounting legal woes, and an unfunded growth pipeline. A US recession or tech bear market would be catastrophic for Tesla in our view. With 40% of Elon Musk's shares, or 8% of the company, posted as collateral for personal loans, we only need to be half right for things to get very difficult for Tesla equity owners. Buyer beware.
Ladies and gentlemen, thank you, Ben. Our final prediction is coming from Phil King from Regal Funds Management. Phil, the stage is yours. Please put your hands together. Thanks.
It's not often you get to make a prediction that many consider shocking, but you have the weight of history on your side. We think the equity market continues to rise over the next few years and the bull market continues. As you've heard today, there are many pessimists around, and we think the scars from the GFC still run deep and will take many years to heal. When the stock market hit an all-time high recently, it set newspaper headlines, and I think it's when all-time highs aren't reflected in the newspapers that you need to worry. 3 reasons why the stock market will go higher. Firstly, interest rates. Equity markets are at crisis valuations. Relative to interest rates, relative to bond yields, the only time equities have been this cheap in the last 15 years have been in the financial crisis and the Greek crisis. And both those times proved to be great times to be buying equities. The bears will say, what happens when interest rates go up? Well, waiting for interest rates to go up is not a good investment strategy. Stop clocks are right twice a day. Interest rates will go up one day, but we all could be retired by then. When bond yields went through 10% 30 years ago, it took a long time for investors to accept this. When bond yields went through 5% 10 years, it took time for investors to accept. It takes time for analysts to put lower bond yields in their models. It takes time for corporates to refinance their balance sheets. It takes time for mergers and acquisitions to pick up. But mergers and acquisitions have almost never been so accretive when corporates can finance acquisitions with such low rates. Secondly, the bears talk about economic growth being soft, but the Australian stock market has never had less exposure to the economy than it has today. 30 years ago, the stock market was full of building materials companies, large retailers, large media companies. These days, the large proportions of the stock market include things like healthcare, REITs, and defensive sectors like infrastructure. And then finally, thirdly, we're a long way behind the US, but the Australian market is finally getting better quality companies, more technology. The sector weightings of stocks like that are rising, and I think that means the market deserves a higher PE. They say the sign of the top in the market is when your taxi driver starts giving stock tips, and that's the end of the bull market. Well, I got an Uber last week, and my driver said he'd sold all his shares because he thought the stock market was expensive. To me, that's a sign that the bull market's got further legs to run. 12 months ago, bond yields were 2% and everyone thought that rates were going up. That was the consensus. Today, bond yields are 1%, bonds are rallied. I think the bull market continues. I think stocks go higher, stay long.
Well done. Thanks.